Welcome to Go Bank Yourself, where we break down how to grow and control capital like a banker. I'm your host, Dovi Herman, joined by my co-host, Pinny Levy. Let's begin.
Welcome to episode 3 of Go Bank Yourself.
Dovi Herman and Pinny Levy. We talked in the last couple of episodes specifically about how somebody would go about building a structure that would allow somebody to control the banking function in their lives. How would somebody be the banker? By building and leveraging capital. And we talked about what that entity would be for us to control the banking function on a you and me level. It sounds like a good idea for today for us to talk about how did banks come to be? How did we get here in this modern financial and economic system? How do banks work? What is the history of modern banking? It goes back 400 or 500 years, back to around the modern banking, at least as we know it, the mid to 1600s. People began saving their gold with goldsmiths. Goldsmiths were working with gold. They were, melting it down, turning it into jewelry. They knew a lot about it. So people decided, hey, rather than carrying all my gold coins, my gold bars around, I'll just leave. Dangerous. People can steal it. Absolutely. Annoying to carry around. They're heavy. So they just left it with the goldsmiths. And goldsmiths...
You'd pay a fee. You'd pay a fee for storage, security. But because if everyone in a region is using the same coin, they're fungible. It means I can give my gold coin and they can give me back your gold coin. It's all the same. If it's the same coin, same weight is what was important. So why not put your gold with a goldsmith and let them pay the capital to store it and to secure it with security? But that led to a problem. You want to talk about the problem?
Well, the problem was that the goldsmiths were sitting on all this gold and people were coming to withdraw the gold. In time, it ended up coming to be that rather than people taking out their physical gold, the goldsmiths would give them basically deposits, like IOUs. Demand deposits saying, oh, you come back with this IOU and we give you your physical gold. But rather than taking out and, the same problem as before, carrying around your heavy pieces of gold that people can steal, we'll just give you this IOU. You can use it with other people because everyone was doing this. Everyone had these IOUs, this paper money. This was an early form of paper money. And the goldsmiths quickly realized that not all the people are going to demand all their gold all at once, so they can lend out more gold than they actually had.
Or lend out more IOUs than they actually have.
There you go.
Right.
That's a good clarification.
The same. And to flesh that out, I've got 100 coins at Johnny Smith Goldsmith. Really, I think there's more, classically they say that the Medici family or Italian, Central Southern Europe is some of the stuff I've read, but...
Funny. I know, you're right. I was actually just doing a little bit of research on this right before we jumped on, because I knew the Medici family was somewhat involved, but it was a different form of banking. That was more like international money transfers and double ledger accounting. It seems like it was different than this goldsmith type lending that led to fractional reserve banking. So different systems, also different time periods. Medici was in the 1400s.
And you mentioned fractional reserve banking, which is the exact parallel to the challenges that we have today. Even every single modern world economy has a banking system, a central banking system that operates like this. So my 100 gold coins and my IOU 100, if I wanted to go to Johnny Smith Goldsmith, I give him the IOU, he gives me the coins. Well, instead, I would rather buy $100 worth of a cow from you for $100, sign my IOU over to Dovi Herman, and you can now present that at your own bank, which would, first at my goldsmith, but then the ability to give it to your own goldsmith, and they would make the transfers between banks. So a bank clearing system, which is the exact parallel to the modern ACH or automatic clearinghouse system. You get a draft out of your account, or I send you money, either a wire or an ACH.
Yeah, because there were only a few families, a few goldsmith systems that were operating like this, because it had to be based on trust. These goldsmiths would, stamp their sign of approval in their whatever signature coin they had. That's how people knew this is a legit gold or silver coin or whatever that was made of. It has to be this level weight, because it still had to be based on trust.
The immediate problem being the goldsmiths realized they could extend credit on gold they didn't have. If I want to give you a loan, I'd say I have a shortfall. I need an extra 100 gold pieces. So they could write me an IOU, or meaning I owe them for 100 pieces, and I could use that as paper cash. But the assumption was that they had their own gold in their bank. So if I and everyone else went and demanded their gold, there's enough physical gold to hand out. Where in truth, they realized they could create debt and collect interest on the debt on money that was never there in the first place, on gold pieces that were never actually there. So they would lend out more money than what was on reserve in their bank, in their vault, in their goldsmith, in their shops. And that is the modern precursor to what we have now. Banks lending out far more that they have in electronic currency. It's even faster now than an old school goldsmith lending out, sending a loan and collecting interest on it on gold pieces that they don't actually have. So
right. It probably worked very similarly, where somebody would deposit their gold with a goldsmith and collect whatever interest rate they were offering, 3, 4, 5%. I haven't looked into what those interest rates were. And goldsmiths were lending money back out, I would think primarily to businesses and governments at whatever they wanted to charge. And you see the same thing today.
Today, a bank with your standard checking account, or even a standard savings account, you're lucky to break 1%. The APY, annual percentage yield, if you look, go log in, go see what it is. You put $100 in, they're paying you $1 a year, or less in most cases. Maybe there's a specialized account like a Capital One that'll commit to 4% a year. Read the fine print. It's not permanent and fixed forever. They have the right to change that, but you give $100 and you're paid $4 a year, less taxes, because that money's reportable if it meets a reporting threshold to the IRS.
I think in a previous episode, I had said that somebody's going to get a 1099 on interest income for anything of like $600 in income, and that is wrong. That's for W-2 income. For interest income, the minimum is $10. So if you have $500 in a high yield savings, you're getting taxed on that.
Exactly. And that's straight out of Nelson Nash's Becoming Your Own Banker. They call it the Willie Sutton effect. Nelson Nash calls it the Willie Sutton effect. Infamous bank robber of the 20th century. Why do you keep robbing banks, Willie Sutton? Because that's where the money is. So he likens that to the IRS will come, the government will come and rob your money wherever it starts pooling, at least if it's greater than $10 in something like a measly, interest earnings on a checking account. But it just goes back to banking, all said and done, is a great business to be in if you can get it. If you could own a bank, if a genie came out and said, do you want a bank with, no strings attached? I'll do all the red tape for you and get it up and running. You should say yes.
You should say yes.
High profit industry.
Yes. Very high profit, with promising to pay depositors between 0.1 and maybe 4.5%, depending on the institution, and then lending to people at, again, depending on the loan, anywhere from 8 to 30%. We see with some high interest credit cards. And we didn't even touch on how many times can a bank lend out that $1? It's not like somebody deposits $100. Oh, so now the bank is lending out more money than they have. They're lending out $150, which would be a lot. But how much?
It's more like $1,000 plus.
More like $1,000 plus.
Right. That's
and we can get into how the calculations work out. It's not that a bank is taking in $100 and making a $1,000 loan, and this is more high level. It works better with reading or visualizing. But a bank can lend out 90% of that deposit to bank B, and then bank B can lend out 80% of that deposit to bank C, so on and so forth, until that $1 is lent
credit,
out
right?
9 times.
Yep. But we should actually provide a link in the show description that how privatized banking really works. It's really a must by Carlos Lara and Bob Murphy. It's a
I
follow-on
think
to the
Nelson
Nelson
too.
Institute. Yeah, Nelson as well. To really show you the problem of the Federal Reserve, go back to the creature from Jekyll Island, if you will, but the mess we're in. And you could say if there were some governor on the system or some failsafe to keep from printing money out of control, but when you couple that ability with politicians and the human nature to promise more, to stay in office, to give more, Rob, the old expression, if you rob from Peter to pay Paul, you can always count on the vote or the support of Paul, right? So it's the easiest
Right.
thing is to make campaign promises to spend more money than get into office and do it. And the Federal Reserve allows that to happen when it's abused. And of course it's abused. It's human nature. So this is the pickle we're in. Ergo, 39 trillion and counting of debt.
Right. And what happens when all this extra money just flows into the economy? Part of the problem is that banks are lending out so much more than they have, so it makes the banking system very flimsy, not a very stable structure, because bank runs are definitely possible, and the banks would not be able to even come close to making good on their promises. But what else is a byproduct of all this extra money being dumped into the economy from fractional reserve lending?
Inflation. We're
Big time
inflating the
inflation.
money supply, which means more money chasing the same, imagine the same amount of goods being chased by more money. The price has to go up. That's an immutable law of economics, supply and demand. Same supply, more money. Same amount of goods being chased by more money means that the price goes up. The sellers can charge more
Right.
and in fact, the money, more accurately, the money is worth less because there's more of it, something from nothing.
And that's the true definition of inflation, is the money supply being inflated like a balloon would be inflated, rather than prices of goods and services going up. The rise in prices is because of the inflated money supply.
There would
I
be
think that's important for people to realize.
right, meaning there's no politician that can wave a magic wand to change inflation. The hardest and the real way to do it, the hardest and it hurts, is like 1981, raising the federal lending rate to 21%. What that did, that denied access to credit and contracted the money supply. Very, very broad brush. It's a deep subject. And it
Sure.
hurts for a while, but creates a tremendous boom in the economy when prices are regulated to what the market actually demands. Meaning now we can only
And
use
on the
our-
topic of
yeah.
And on the topic of the definition of inflation, I do think it's really important for people to realize that, because something that I've heard from many different areas are politicians blaming capitalism, the free market, business owners for inflation because they're the ones raising prices. Damn these business owners, these greedy business owners, they're raising their prices and creating inflation. That's not how inflation works. And by politicians, whether they believe that to be true or not, it's very easy to just blame something else and redirect. Don't look at the real problem. Look over there. Blame them. It's the greedy capitalists.
Exactly. Those greedy capital. Well, that's a way for politicians to put the blame somewhere else. The real problem is government spending and taking off the limits of the Federal Reserve to print more money. It is the system. It is the Federal Reserve System. But back
It
at the
is.
heart of it is these banks. A bank that's part of the FDIC is making bank. As you pointed out, these days they might have on the low end a 30-year, 8% mortgage, a 10% personal loan or home equity line of credit, a 12% business loan, somewhere in the mirror, 8 to 10% car loan.
Agree with all of that except the mortgage. The mortgage is probably closer to 4 to 6.5%.
Again, read the fine print. If your down payment is high enough and your credit is good enough, right? Maybe you could get lower rates on the mortgage. I mean, the 30-year mortgage should be the lowest interest rate product, all the way up to subprime car loans in the 20s, and as you mentioned, credit card loans in the 30s. Add it all up. The bank is making 50% plus on the money that it lends out and paying you that 1 to 4% on the very, very high scale, 4%. on the
Yeah.
high end. So wouldn't you want to be a banker? And the point is, the layman to go and create a bank, well, hundreds of millions on reserves that you'll need, grease the right politicians, the right certificate to conduct banking in your state, get on the waiting list. It's a decade plus process. But through participating whole life insurance and the infinite banking concept, creating your own conceptual bank can take weeks, not years. So that's what we want to sort of format the brain to thinking, I want to be a bank. It's not a bad thing. It's not a bad thing when you own it and you have the potential to earn those interest rates, much like a banker does today. And you have to see becoming your own bank. You have to see how privatized banking really works to get a fulsome understanding of all those aspects of banking that you can replicate in your own financial life with an IBC designed life insurance policy. Before the fractional reserve lending, the problems that we talked about, banks, you deposit $1 and it trickles into the system as 10 when it's lent and relent from other banks. How did that, if it's so preposterous to us now, how did it all start? Where even in our country, was this since day one, George Washington, Federal Reserve?
It was a process. There were different forms of central banking. The experiment that was the United States of America had a really good run of about 15 years, maybe less, until Alexander Hamilton started campaigning for a U.S. central bank. And he won. And there were different forms of it. There were, around the time of Andrew Jackson, politicians tried to bring it back, and he was against it. That's one of the reasons Andrew Jackson gets a lot of flack in the history books, because he was not a central planner. He was for more economic freedom. And 1910, was it 1910 or 1913?
1913. You're talking about the Federal Reserve Act. It's December 23rd, 1913. Yep. So the result of which is a plan to enact the Federal Reserve Act, which, as you said, passed on a night when nobody's paying attention, right? This is like the modern day version would be the press release on a Friday afternoon when nobody cares, and come Monday, nobody's going to see it. So, But here's the Fed. Here's our new Federal Reserve Bank, where they put in the predecessors to the power now of a bank to say, I want to make a loan. Practical terms. When I bought my house and I went to the seller and said, I've got a mortgage secured. Of course, they weren't taking $300,000 out of my account. It was a mortgage. They were lending. They were extending me the credit. But does it mean they had $300,000 in their vault to lend to me to immediately give to the seller of my house? No. They had to have something like a tenth of that on hand. And the Fed lets them write the debt to me. Now, I have a 30-year debt to pay at interest, separate subject, but I like to point out over and over, at the time it was a very good rate, 3.875. Might have gone a little lower, but it's certainly great compared to the rates you can get today. Just refer back to becoming your own banker. The rate of interest, the APR, is 3.875. The volume of interest is something north of $200,000. So that aside, the bank is creating this 30-year debt for me, and they simply created an account for the seller and put the money in his bank. At the time, his bank receives a wire for $30,000, or there's a escrow in the middle of the title company, but $300,000, and that immediately lets his bank lend in that whole trickle system we talked about until they've lent out $3 million based on the $300,000 that he just put into his account. Again, you got to see how privatized banking really works for the nitty-gritty interbank transfers. But here's the modern day version of creating something from nothing, creating an obligation for me to pay, and that itself is what injected the cash into this seller, the home seller's bank.
Right. And this whole concept is completely backwards when you look at how Austrian economics talks about how a business cycle should work, or how a bank should operate, and we should be operating like this in our own lives, where we should be saving first before spending. But this modern banking system and economy in general works on a spend first fashion. Let's go into debt and
then pay it back. It's all part of the mindset. Do you want the shiny object now? I've been using the analogy lately. Do you want one lollipop now? I guess the original experiment was marshmallows. Do you want one marshmallow now or two in 10 minutes? And everyone's going to say, I want it now. I will go into debt now. And what's the real pixie dust over their eyes is that, well, I can afford it. What's another $100 monthly payment for cable on my bill? Or cable isn't exactly a debt, but what's another $300 car payment? We need it, or we want it. We deserve it. That third car. Yeah, let's do it. It's only another $300 a month. And you've now entered into nominally an 8% debt for 5 years for a couple $1,000s of interest that, had you saved up the money first, you could have done something like your own banking system, like infinite banking, where you're for the most part retaining that interest inside your own system instead of just sending it like water under the bridge, gone forever. And that's part of the habits that we should definitely get into, not today, about how should finances really be taught, and how should we really categorize our income, our expenses, our savings, and our debt to keep any amount of debt. Not that debt is not taboo, but too much debt with someone else's bank is definitely killing the American economy.
Yeah. When you're talking about habits and how people think about money, like you said, what's another $100 a month? I make $10,000 a month, so what's $100? 1% of my monthly income? Well, when you think about it, we all have these fixed expenses. Mortgage or rent, your car, your insurances, tuition, whatever, food, whatever it is that you can only minimize your expenses so much. There are baked in expenses for just to live your life. So when you think about like net income, net cash flow, what percentage is that $100 of your net, of what you can actually spend in the month after you're paying for everything that you don't really have a choice? That money is going out the window.
And the answer, probably too much. Probably somewhere between I want it or I deserve it, like a toxic way of thinking, or it's on sale, so I can't afford not to buy it. Whatever the gimmick made us make that decision, that poor decision with our money, well, that's something we can, again, parse in a different time.
So we covered a lot. We covered some of the history of how modern banking came to be, with goldsmiths realizing that they can do fractional reserve lending and they can make money in all these different ways, and how that's parallel to our modern banking system, and how not only is the customer getting screwed on the system of interest of what they're paid being what they're being charged, but how that's leading its way into inflation on the national scale and the global scale. There's a lot more to cover there, but I think we were trying to keep these episodes somewhere in between 15 and 30 minutes for now. We haven't mentioned it yet. Please, everybody, listen, like, subscribe, comment, throw us your hate. We're ultimately bringing this back up to the idea of becoming your own banker, not being a customer or depositor of commercial banks, but taking control of the banking function in your own life. And we do that by the use of dividend-paying whole life insurance policies with select mutual companies that we talked about in the first 2 episodes. And we're going to talk about a whole lot more. We're going to keep talking about banking and whole life and savings and personal finance in general. So if the word whole life insurance is so triggering to you that you already think we're rip-off salesmen and snake oil salesmen and we don't know what we're talking about, throw that in the comment section too. We'd love the engagement. We might respond, we might not. We might bring you on the show so that you can tell the whole world about how we don't know what we're doing.
If someone loves it so much or hates it so much, we want to take the mean, right? So take the average of love or hate if you really want to come on the show. But thanks for tuning in, and we'll see you next time.
All right, see you next time. Thank you for listening to Go Bank Yourself. To learn how to apply these strategies in your own life, email Dovi Herman at realchangefinancial.com. We'll see you in the next episode.